Hello everyone and welcome back to Finance with JCL, the show for beginner and intermediate level investors. And a warm welcome to new listeners, and I welcome back those that have joined me previously. Today's show is around market crash and whether a market crash can actually be an opportunity, so I'm to demonstrate that to you, and then how that crash could help you meet your long-term investing objectives. So I'd like to start with Warren Buffett. Warren Buffett, one of the handful, top few richest people in the world. His net worth is almost $72 billion as of July this year, and that's been made through the medium investing. So this guy is well qualified to talk about investing, and he believes that we should be fearful when others are greedy and greedy when others are fearful. So at the time of a market crash, he is suggesting that one should be greedy, which is sort of counter to the standard human behaviour. So let's have a look as to why he believes that's the case. So to dig a bit deeper, in the short term, the stock market is what one might term a voting machine. That is, popular companies increase quickly, unpopular companies drop dramatically, even if their long-term cash generating ability hasn't really changed. So the market will fluctuate wildly in the short term, but in the long term, it's what could be called a weighing machine. So actually, how good your company is really count to the long term, regardless of those sort of short-term fluctuations based on events or popularity. So that's something to bear in mind. So don't be distracted by short-term changes, although there could be an opportunity. Do always think about the long term. Is my company or is my investment with the index I bought, is that still a good long-term investment? Will it still generate the cash for me? So I'll use the index example first. So I'm looking at the S&P 500, which is the benchmark American market index. And this is based on the last 12 months, so it takes into account the COVID crash. And you can see that as of March, the market was around about 3,400 or so, which is sort of record high territory. And it dropped all the way down to 2,200 in the space of a couple of weeks before recovering to around about 3,300. So that's a drop of around about 33% and a gain of around about 50%. So the opportunity, if you're investing in indexes, and I will come on to individual companies after, is that if you're buying an index over a period of time or have bought some in the past, the market crashes like this. You've got the opportunity to lower your average purchase cost by buying when it drops down to that lower level. Now, you're unlikely to time the bottom point of 2,200 to the day, but as it drops and it's below your previous sort of purchasing average price, you can top up and double down. So when it does recover, and this year it recovered, whether temporarily or permanently, quite quickly, you're going to see some nice gains there. So the other thing to note is if you are a long-term investor, which is what we're trying to achieve here, and you sell whilst the market's dropping, you'll actually crystallise a loss. So lots of people are scared, they're selling things off, they're trying to avoid losses. But if you actually participate in that short-term action, you guarantee a loss. Whereas if you trust that the historic long-term trend, which has always been the stock market rising in the long term, though not guaranteed, that's always what's happened. If you trust in that, hold on to your portfolio, then add to it as the market drops. And that will help you achieve your long-term investing objectives. And just for a comparison, I'll add a link in above for mine so you can see what I'm trying to achieve. A case of an individual company, this is Apple in the last 12 months. You can see since last summer, it's been building up to about 325. And in the crash, it dropped to 225. So you're talking a loss of about 100 there, so something like 30%. And actually it then shot up quite quickly to what is now about 370. So that's a gain of around about sort of 145. So that is over 50%. The drop of 30% was followed by a gain of over 50%. So you've got Apple as a company in your wish list. So you've done the due diligence, you know that you're happy with the company, you know what price you want to buy it at, but it hadn't reached it. If it did reach that price during that drop, you should buy. as long as you're happy the long-term ability of that company to generate cash hadn't changed. So the market crash presents the opportunity of lower prices, whether justified or not in the long run. If you think it's not justified for that company and it hits your wish list price, buy it and double down because it's hit that price. Really go in hard for it. That would be what I do. Now, of course, you need to look at your own circumstance and take your own professional advice, but that's certainly what I would be doing. I do have actually Apple on my wish list. I've got a video on that, so I'll drop a link in to allow you to have a look at my analysis of Apple. So the opportunity in detail, index trackers, they've got very low fees, and you don't have to worry about these individual stocks because in a market crash, presumably something's happened in the economy, and therefore some particular companies might be in trouble. In this case, it could be airlines, for example. So you don't have to worry about that because you bought the index, you bought the American market, a bit of each of those 500 companies at a really low price. So you've got the opportunity to buy more of it at a lower cost. And therefore, when it does rise, which in the long term historically it always has done, you've got more upside. And the opportunity on your wish list companies, they might be on sale. So it's a bit like when you go to the shop and let's say, oh, I really wanted that particular jacket. It was £80, $80, it's too expensive. You happen to walk past, there's a 1 week sale and it's on for 50. And you think, yeah, I thought it was worth about 60. So if it's on for 50, I'll buy it. But you have to act quickly because that sale's on only for a week. And that principle is the same here. So if you've got something you've identified, you believe it's strong and not impacted by the markets or the economic problems in the long term, you've calculated a price that you want to buy it at and it goes below that price, hit it and act very quickly. Cool, so that's the opportunity for index trackers and companies on your wish list. So in summary, there's a great opportunity in a market crash to lower your average cost if you're participating in index trackers, if you're investing. Conversely, if you're looking at individual stocks, you can buy them potentially whilst they're on sale, as long as it hits that target price that you've already determined. But do note, you should sell companies that are materially impacted in the long term. So for example, during COVID, an airline could be a good example here, where it looks like for several years, they're going to struggle to get back to the numbers they're at before. Now, don't be afraid to take a loss. Do sell them because the money you get, even if it may be a loss, you could put to better use in a high quality stock or an index. So never be afraid to take a loss if it means you can put your money to work in something better. And then finally, I think it would actually be good to hold some cash in your portfolio. Not a huge amount, but do have some cash so you can take advantage of these unusual events when they occur. Because when they do occur, you need to act quickly to secure your particular stock or index at that lower price point. So in summary, we like sales. Cool, so thank you very much for listening and joining me today. If you want to hear more and find out when my next video is released, and there's at least 40 more planned, please do hit the subscribe button with the bell notification as well, and you'll then be alerted as to when the next one comes along. And also please hit the like button if you found this information useful. I'd really appreciate that. And it also means that the video becomes more prominent on YouTube, so it gets recommended to other people so we can spread the word. So I hope you found the show useful today, and thank you very much and see you next time.